Welcome to Fall 2015 Financial Accounting 210. I apologize that this first little piece of lecture was unable to be delivered in class. That's traditionally what I do, but I think this will work out as well. I'll get you familiar with some videos in the first couple chapters and what's required of you. It also gives you some time to reflect on all the information I provided to you in class regarding how to actually attack the chapters, both with reading the chapter, slides, presentation, in-class lecture, homework, and so forth. This first slide presentation or video, as how you look at it, will be fairly simple. It's having to deal with terms and assumptions. I won't go over a lot of the slides in in-depth detail as they are presented in the textbook rather well and actually in exactly the same format. So I want to make sure that we kind of just get started here and that I call out information to you that I feel is important with some additional explanation. So let's go ahead and get started, and I'm excited for this semester, and I hope you are as well. So accounting basically is what we call the process of identifying, measuring, and communicating economic information. This economic information that we provide allows the decision makers to make judgments and decisions regarding their business, like should we hire more people to produce the product? Do we need to do more advertising? Do we need to cut back? Do we need to lay people off? Do I need to take less salary as an owner? So it allows the businesses to make judgments and decisions. We talk about accounting being simply the language of business. So what it is we take economic information or business transactions, we put them into a canned format that everyone in business is used to seeing, and we apply some rules, and that is applied to all the businesses that are using a certain kind of format. And then that allows us to be able to look at companies' financial information and be able to make judgments on those. So to be able to do the process of accounting, we have four major assumptions. The first one is what we call the economic entity. Simply stated, it states that financial activities of a business are to be kept separate from that of the owners. So let's take a minute and reflect on what that means. What that means is, let's say I own a landscaping business. In the landscaping business, I have a truck, I have tools, and I have employees. When I go out and perform my services, people pay me money. What I have to do is keep the money that I receive for the landscaping business separate from my own personal money, as well as any money I spend on behalf of the landscaping business, like gas for the lawnmowers, new equipment, fertilizer, spray, etc. Okay? How can I do that simply? In simple terms, I can open up two checking accounts. One for the landscape business and one for my personal. All of the revenue or monies coming into the landscaping business would go into the landscaping bank account. All of the expenses going out for that would come out of the landscaping business. And then if I take money personally as salary from the landscaping business, that money would go into my personal account where I would be able to pay my mortgage, pay my utilities, car payment, etc. So it's simply keeping the financial activities of personal and business separate. The second assumption is that we're going to assume that this economic information is meaningful if we communicate it over short period of times. So we have what we call a time period. All companies typically act in a 12-month period. The 12-month period is a year. Now, that year can be January 1 to December 31. We call that the calendar year. Or it can be any 12-month period, for instance, November 1 to October 31, which happens to be HP's year, and we call that a fiscal year. A fiscal year. Okay? So companies can operate on the calendar year, or they can operate on a fiscal year. Walmart is February 1 to January 31. Apple is October 1 to September 30th. Let's think about that. Let's stop for a moment and ask yourself the question, why would companies have different year ends? So as you're thinking about that, think about the type of business Walmart does. Think about how Apple operates its particular business. Think about Hewlett-Packard, November 1 to October 31. And the reason that you should come up with is what we call seasonality. Let's think about Walmart. What is Walmart's biggest season? It's Christmas. So we are going to want to have that at the end of our year. And so we go ahead and make sure that our seasonality is covered. In the technology business, or places like Target and Walmart, we have seasonality. And think about it. We have back to school. We have summer. We have holiday. We have Halloween. We have Valentine's Day. We have Easter. We have Mother's Day and Father's Day. Some are bigger at other stores than they are in other consumer stores than they are at others. But we want to make sure we capture that in the right time period in our fiscal year. So companies pick that accordingly. Think about Apple. What does Apple do every September? You all should be shouting out loud that they announce their new iPhones, always around September 10th. Therefore, in the last 3 weeks of September, they have a huge increase in revenue. Companies are always thinking about that when they design their time period. Now, we always shorten that time period to see economic results in shorter time periods. It could be monthly. It could be every 3 months, which we also call a quarter. Okay? It can be every 6 months. When you do financial statements, we do them for the month ending August 31st, or for the 3 months ending September 30th, for the 6 months ending June 30th, whatever that time period is. So that time period is normally captured in monthly buckets, like HP reports monthly on their resorts, but basically to the world we report quarterly. Okay? And so those are our time periods. When you get into the financial statement section of the lecture, you'll start to understand which of the statements and how the time period affects them. The third assumption is, hey, we're going to count everything in monetary units. Here, for us, it's in the dollar. Okay? If I was in Britain, it would be the British pound. If I'm in Europe, then it's the euro. But for here, for us, we communicate it in dollars. And the last assumption is what we call is the going concern. We as accountants, or beginning accountants, will assume that a company will continue into the foreseeable future, which means this company is a going concern. It's going to continue in the foreseeable future. If you as an accountant think that it isn't, then you will notify the company in the financial statements that it is not. And I'm not sure where the pictures are on this. All right, well, that's not fortuitous, is it? So the slides didn't transfer exactly as they should. So we'll go ahead and write in the information. Who says we can't adjust here? So let's talk about qualitative characteristics. Okay, in business. So if you all want to go ahead and turn to page, where are we? Let's go ahead and turn to, it's not even, page 15. Sorry about that. See, it's like a real life in class lecture as I start, okay? So if everybody turns to 15 or thereabouts in your textbook, it says qualitative characteristics that make accounting information useful. The first one of those is what we call understandability. Understandability. Accounting information should be comprehensible by those willing to spend a reasonable amount of time studying it. So that's why you're all here. You're here to, hey, what makes a financial statement and what are the underlying theory behind that? The ramifications of that is users must spend a reasonable amount of time studying accounting information for it to be understandable. So that means that even the CEO has to be able to understand the information that you're presenting to them and where it comes from. The second qualitative characteristic is relevance. So relevance in accounting information means that it has the capacity to affect decisions. Capacity to affect decisions. And what that means is it has to be relevant to me. Information should have predictive or feedback value, and it needs to be timely. If you tell me what I did for the last 3 months, 6 months from now, it in fact is not relevant to me because so many other business things have happened during that time period that that information is no longer valid, okay, or relevant to me. In addition to that, I should be able to look at it and be able to project forward to get an idea of what I need to be doing in my business. So it needs to be relevant. Third, it needs to have reliability, or it needs to be reliable. Accounting information should be dependable to represent what it's supposed to represent. Information should be free from error, and I should have faithful representation, and it should be neutral. We should be able to tell the story based on the numbers, okay? We shouldn't go in and manipulate it, although there is some done legally, and then there is some done illegally. But I need to be able to rely on that financial information that you were showing me because remember, I am going to be making decisions on it. So therefore, you need to be showing me the truth and free from errors. that information also needs to be comparable or have comparability. Accounting information should be comparable across different companies. That means I should be able to take Apple versus HP and be able to compare the numbers. Although Apple is going to show much higher numbers than HP right now, I'll be able to compare it by something that you're going to learn a little bit later called horizontal and vertical analysis, where I common size the financial statements to look at the percentages. Is my cost a percentage of revenue the same as Apple once I common size it? And we're going to learn more about that in a couple of the future chapters. But I should be able to compare it to help make decisions. Besides having relevance, reliability, and comparability, it also needs to have consistency. It needs to have consistency. The information should be comparable across different time periods within the same company. Like what I did in Q1, similar to what I did in Q2. If not, and when I say Q1, that's quarter one, quarter two. And if it isn't, then why not? What did I do differently? Was it higher? Was it seasonality? Did I do a big marketing campaign? So I want to make sure I have consistency across time periods. So an entity should use the same accounting methods year to year. We call that year over year. We use the same accounting methods. If we change them, then we need to call it out. It doesn't mean you can't change them, but if you do change them, you need to call them out. In addition to that, we have a term called materiality. Okay? Materiality is what we call the threshold. Okay? It's the threshold over which an item could begin to affect our decisions. In other words, small errors, why we don't like them, usually do not affect overall decision making. A pretty good story that I had once is I had in my CPA practice a lot of small clients. And so, man, I would go and look for errors that were like $1,000 or $10,000 because that was really meaningful to my small little company who maybe only had revenue a year of $1 million. I mean, when you're looking at $10,000, that starts to become a larger percentage. So when I started working for Hewlett-Packard, I spent the longest time looking for an error that I think it was like $30,000 or $90,000 or something like that. And my boss said, "Why are you looking for that? We don't look for anything that is $500,000 or less for materiality." And that's because they were at that time a $150 billion company. So materiality will be based on the company and what threshold would your company make a different decision based on materiality. And lastly here on this particular page is what we call conservatism. When uncertainty exists, accounting information should present the least optimistic alternative. So an entity should choose accounting techniques that safeguard overstating revenues or assets. An example of an asset is cash, and we talk about that in some of the later videos. So conservatism. I always tell my students I'd rather underreport than overreport. I'd rather underestimate than overestimate. If you underestimate within reason, you're a hero when you come to your boss or management and you tell them you exceeded your estimates. When you overreport, then you spend days trying to tell them what went wrong. So we always want the art of conservatism. Remember that people need to have reliable information and it needs to be relevant, because remember, what you do affects decisions. So if you're going to say you're going to have more than you really are, you may have made a decision to buy a piece of equipment, and then you come to find out you're not going to do that, and now maybe you can't afford the piece of equipment. All right, let's move. Okay. Next, we have what we call the conceptual framework. So the conceptual framework, or basically of accounting, is the collection of concepts that guide the matter in which accounting is practiced. So therefore, we have grammar or terms, which we're talking about, explaining financial accounting language in this chapter, are more formally known as the components of the conceptual framework. And so all these informations that we're talking about right now is just basically the guide in which we can have meaningful discussions when we're talking about the financial statements. So let's take a look at some of those terms to identify and describe economic information. So the first one is assets. Okay? An asset, by definition, is the resource of a business, and it's reported on the financial statement we call the balance sheet. And again, you will get that in further videos on how to prepare a balance sheet. So assets typically are resources of a business. So let's think about what might be a resource to you. So cash would be a resource. Okay. Inventory would be a resource of a business, right? Because we would sell that information. We would sell inventory to get money, which would mean then that we would have money. So that would then be a resource. So those are some examples of what assets are. If you go to the back of your textbook, there is something called a comprehensive chart of accounts. Comprehensive chart of accounts. And in the first column, it says assets on them. You'll see cash, petty cash, accounts receivable, which is money owed to you. You've performed a service or sold a product and somebody owes you money. Allowance for bad debts, we'll talk about in chapter 6. Interest receivable, somebody owes you interest. Inventory, notes receivable, we'll talk about later in chapter 6 as well. Office supplies, prepaid insurance, that's insurance you've paid in advance. Prepaid rent, rent you paid for it in advance. Short-term investments, we'll talk about later. Supplies, buildings, equipment, land, depreciation, we'll talk about in the future. Copyrights, goodwill, and patents, we'll discuss in chapter 8. Those are all examples of assets. If we go over to the next category, next column, or the next term down, we talk about something called liabilities. Liabilities are an obligation of the business. In other words, that is what you are going to pay out of your assets. You pay liabilities. So basically, you're going to use cash to pay the utility bill. Those are also on the balance sheet. A list of liabilities starts with accounts payable. Accounts payable is money you owe to people for product, for utilities, for telephone, for advertising. Dividends are something we'll talk about in Chapter 10 in detail, but dividends payable is a way that you can pay money out to your shareholder. We have a whole series of taxes payable. That's money you owe to the government. We might owe interest on a bank loan, which is what we call a notes payable. You may owe money to your employees. Again, we talk about taxes. We talk about different payables. Any time you see the word payable, it is a liability. It doesn't matter what's in front of it. The same goes with any time you see the word receivable, someone owes you or your company money. So anytime you see the word payable, you owe a person money, and anytime you see the word receivable, they owe you money. Our third term used to identify economic information is equity. Basically, equity is the difference between assets and liabilities. So effectively, assets minus liabilities equals owner's equity. Better known, as you'll see further along here, is the accounting equation. And equity is found on the balance sheet. You can go down here under equity and see that we have common stock, dividends, contributed capital, retained earnings. Those are categories of equity that you'll get more familiar with here as we move forward. Contributed capital is equity resulting from contributions from an owner. And again, we'll get more familiar with that. Retained earnings is the results from profitable operations. Again, it's on the balance sheet and statement of retained earnings. Revenue is an increase in assets resulting from selling a good or providing a service. In other words, if we go back to our landscaping business, we go out and we mow someone's lawn, that is revenue, and when we put it in our bank account, it will increase cash. For an expense is a decrease in assets resulting from selling a good or providing a service. So in other words, if I get gas to run the lawnmowers, that's going to decrease cash, my asset, because I had to pay it to the gas station. If we go and we look at that same comprehensive chart of accounts, you'll see a list of different kinds of revenue and a list of all of different kinds of expenses. Believe me, this is not all inclusive. This is just some examples. And then at the bottom here, you see dividends, which is a distribution of profits to the owners, and that will be reflected on the statement of retained earnings. So, in addition to those terms, we also have principles. These principles are very important to how we represent the economic information. So the first information or term or principle here is what we call the revenue recognition principle. So the revenue recognition principle is that revenues are recorded when they are earned. It doesn't matter if you received money for them. So they're recorded when they are earned. So that means in my landscaping business, I went out and I mowed the lawn, but those people have an account with me, which means I bill them once a month. So and then they send me a check in the following month. It's kind of like how you do utilities or cable or your cell phone. So what that means is even though I didn't get the money, let's say till September, but I did the work in August, because I did the work in August, because I earned it, I could recognize the revenue, which means I'm going to say that I made $100 in August, even though I physically don't have the cash, which is what it says here. the receipt of cash is not required to record revenue. Earning it triggers the recording of revenue. So revenue when earned is recorded, and then the offset of that is the cost or expenses are recorded when they are incurred. Okay, so if we come back to this matching principle, we want to match revenue with expenses. So that means that revenues are recorded when they're earned and expenses are recorded when they are incurred. That means if in fact I had a building and I'm using the electricity, but I don't pay the bill till September, I'm going to go ahead and record that electricity bill in the month of August. In other words, in the month I used the electricity. So therefore, the revenue recognition period principle and the matching principle go together. Okay? Because the rule is I recognize revenue when earned and expenses when incurred. For many assets, the cost of the assets must be spent over many periods. We call that depreciation. We'll talk about that later in the class, in the semester here. But what we want to do is we record the expenses when we incur them to help generate the revenues. So the rule of thumb is, hey, I need the utilities to run my office to generate the landscaping business because I have to do my billing there. I assemble for company meetings. So expenses help generate revenues. Therefore, we're going to match them up. Last but not least, when we have costs or certain expenses, assets are recorded and maintained at their historical costs. So that means if I buy a piece of equipment for $100,000, I'm going to record it for $100,000. It doesn't matter that down the street, that same piece of equipment is $120,000. It doesn't matter. That's the market value. I don't care. I paid $100,000 for it. That's what I'm going to record. So it doesn't matter what the real cost of this is. We are going to record it at their historical cost, and what that means is what we paid for it. More assumptions. This is kind of repeating what I talked about at the very beginning. And again, these tables are both in the slide presentation on Blackboard and also in your textbook. I'm going to get, this is just for your information and you can go to. We went over the qualitative characteristics that make accounting information. And if you remember, it was understandability. In fact, why don't you quickly jot them down on a piece of paper here, and then we'll see how you do. Let's see if you can get the 6 or 7 qualitative characteristics. So I'll give you a minute, like Jeopardy. All right, let's go ahead and see how many of you got. So we have understandability. You got to be kind of versed to be able to read financial statements. You have relevance. You guys don't have to have them in this order either. You have reliability. And these little fat pens are hard to write with. You have comparability. You have consistency. You have materiality. And last but not least, conservatism. They always write bigger. Here we have the financial statements, which is going to set you up for learning the rest of the learning modules. We have the balance sheet, which shows a company's assets, liabilities, and equity at what we call a point in time. So it would be as of December 31. When we do an income statement, it's for a specific period of time. So it would be for the 3 months ending December 31. Okay? It's for a specific period of time versus a point in time. As of 4. Okay? Talks about the different statement of cash flows. Although I feel it's the most important statement in the financial statements, you get that in Accounting 220, unless we have some time at the end of the semester to kind of start that concept. So you're not responsible for that. You're just going to be responsible for 3 financial statements. And that's your first lecture on terms and terminology. Again, I would take the opportunity, if you haven't already, to go back and read the chapter. There's going to be some homework assignment on Cengage that's pertaining to this part of the lecture. And so feel free to go out and do that part. And then the rest of the videos would pertain to the second part of the Cengage homework assignment. So hopefully this was helpful. We'll talk to you soon, and good luck.